If you are filing a small business tax return in 2026, this video is for you. Several tax rules updated for 2025 returns, and if you do not account for them now, you could overpay taxes or trigger IRS notices. In this video, I will walk you through the most important 2026 tax changes that affect your 2025 return, what actually matters, and what you should double check before filing. Quick clarification before we dive in. When we say 2026 tax changes, we are talking about rules that apply to your 2025 tax return that you file in 2026. This includes inflation adjusted limits, updated thresholds, and rules that became effective during 2025. Everything we cover today is about what affects the return you are about to file, not future planning for a 2026 income. Let's start with tax brackets and the standard deduction, because this impacts every small business owner. For tax year 2025, which you file in 2026, the IRS increased tax brackets and the standard deduction due to inflation. The standard deduction for 2025 is $15,750 for single filers, $31,500 for married filing jointly, $23,625 for head of household. Let's say you are a single consultant with $100,000 of net business income in 2025. After the standard deduction, your taxable income drops to $84,250. If you were using 2024 numbers in your projections, your taxable income would appear higher than it actually is under 2025 rules. That difference can affect which tax bracket part of your income falls into and whether your estimated payments were accurate. The Qualified Business Income Deduction, also known as QBI, is still available for 2025, but the income thresholds increased. For tax year 2025, the QBI phase-out begins at $197,300 for single filers, $394,600 for married filing jointly. The phase-out range spans about $50,000 for single filers and $100,000 for married couples. Here's a real-life example. You are a single marketing consultant operating as an LLC taxed as a sole proprietor. Your net business income for 2025 is $170,000. Because you are below the threshold, you may qualify for the full 20% QBI deduction, which would be $34,000. Now compare that to someone earning $215,000 in the same business. That person may see their QBI deduction partially reduced or eliminated, depending on where they fall in the phase-out range. This is one of the most important changes for 2025 returns and also one of the most misunderstood. For tax years beginning in 2025, Section 179 allows you to expense up to $2,500,000 of qualifying equipment and property. The deduction begins to phase out once total qualifying purchases exceed $4 million. Now let's talk about bonus depreciation, because this is where people get tripped up. For 2025, bonus depreciation is not one single percentage. Due to law changes and transition rules, some assets may qualify for 100% bonus depreciation, while others fall under the 40% phase-down rules. Here's an example. You bought $100,000 of equipment in 2025. Depending on when the asset was acquired and placed in service, you may be able to deduct the full $100,000 immediately or only $40,000 under bonus depreciation, unless you elect Section 179. For further details, check out my video where I covered this topic in full. Now let's talk about the business mileage deduction. For tax year 2025, the IRS standard business mileage rate is 70 cents per mile, up from 67 cents per mile in 2024. Here's what that means in real dollars. If you drove 12,000 business miles in 2025, your mileage deduction is $8,400. In 2024, that same mileage would have produced an $8,040 deduction. That is an extra $360 deduction without spending a single additional dollar. This change matters most for service-based businesses like consultants, real estate professionals, and anyone regularly driving for client work. As always, the deduction only applies if you maintain a proper mileage log and you are eligible to use the standard mileage method. Now let's talk 1099-K, because this is where a lot of people are still operating off last year's headlines. For tax year 2025, the federal 1099-K reporting threshold is back to the older rule due to one big beautiful bill signed in July 2025, generally over $20,000 and more than 200 transactions for payments for goods or services. The IRS confirmed this in updated guidance and FAQs. Two important real-world notes, though. First, even if you do not get a 1099-K, the income is still taxable. A missing form does not mean tax-free. It just means less third-party reporting. Second, platforms can still send you a 1099-K even if you are under the threshold, and the IRS can still match other forms like 1099-NEC or 1099-MISC. So your goal is not avoid forms. Your goal is clean reporting. Let's say you made $12,000 on Etsy in 2025 across 80 transactions. Under the federal threshold, you might not get a 1099-K, but you still report the $12,000 on Schedule C and you still deduct your expenses. Here's what causes IRS headaches. The IRS runs matching programs. If third parties report income and your tax return does not reflect it, that's when notices happen. The most common one is a CP 2000 notice, which is basically the IRS saying, our records show more income than what you reported. This is why you should do a reconciliation step before filing. Make a simple list. Total deposits received from payment processors, total revenue recorded in your bookkeeping totals from any tax forms you received, like 1099-K and 1099-NEC. If those numbers do not tie out, you find out why before you file, not after the IRS sends a letter. To wrap this up, several tax rules changed for your 2025 return, including inflation adjustments, reporting thresholds, and deduction limits. Business owners who review these early tend to pay less tax and avoid stress. If you found this helpful, make sure to subscribe so you never miss important tax updates for small businesses. Thank you for watching.